Hello, everyone, and welcome back to Your Finance TV. What an interesting week it has been. Obviously, we've had the US elections. Obviously, we've had a little bit of a rate cut. We've also had some stuff in China, stuff in Germany. And who better to talk to about all of this and wrap it up in one little basket than Jay Pelosky? How are you, Jay?
Scott, you're absolutely right, buddy. It's been a week, right? We were down in Brazil last week, had a fantastic trip. One of my favorite countries, goes back to one of my first jobs, launching a Brazil fund for Morgan Stanley way back in 1990. So great to be back in Brazil and then come home over the weekend and move right into the US election. And as you said, pretty wild times.
Well, let's have a look at the title of your musings this week, Lessons Learned. Now, let's dig into this one for us, Jay.
Yeah, well, there are lessons to be learned when markets move as rapidly as they have been, and when politics are in the mix. We had the opportunity to do a lot of TV this week. We were asked to guest host for an hour on Bloomberg's election night special Tuesday night, which was quite an honor. And that turned into 2 hours from 11 p.m. to 1 a.m. And in the midst of that, it became clear that our view of the political outcome, namely that the Democrats would win handily, we used the term landslide. We had to give a mea culpa on national TV at 12:50 in the morning. I guess the good news is I'm not sure how many people are watching at 12:50, but we had to step up and admit we were wrong. So lesson one is being a professional and admitting when you're wrong and stepping up and taking ownership and then moving forward. So lesson two, right on the same vein, was, the challenge to separate the personal side from the professional side, right? I mean, personally, I'm quite disappointed and even depressed about the outcome. But professionally, our job is to understand and impact how things are going to impact the markets. And so clearly, we have to be able to separate the two. So likewise, kind of a lesson in professionalism that we've gained, frankly, both Tuesday night and then Wednesday morning when we were asked to come back on Bloomberg at 8 a.m. So a mere 7 hours after we had left the studio, we were back for a really good segment, which we included in our musings for those viewers of yours who are also readers of our musings. We included that clip. So, an awful lot to be learned for sure.
Well, once again, if anyone wants to sign up for those musings, they can go to Pelosky.com. Now, for people who haven't actually watched this show before, which would be quite shocking if they haven't, you're a big Duke man. You also had the opportunity on Tuesday to speak to one of the coaches there at Duke. What lessons have you learned from that conversation this week?
Yeah, actually, it was a real plus of Tuesday, and it's funny how the things juxtapose, right? So we had the chance, a group I'm part of at Duke had a chance to speak with the defensive coordinator, Coach Jonathan Patke, about his defense, which is ranked in the top 20 in the country and in the top 10 in terms of things like tackles for loss, takeaways, etc. And he talked about, playing fast and loose, encouraging the kids to play with an edge, and having what appears to be a complex defense to the opponent's offense. In other words, when the offense looks at his defense, it's complex. They can't really figure out where he's moving his pieces around, for example. But to the players, that defense needs to be simple so that they can play again fast and loose and free. And it was really an interesting juxtaposition because it's the same on TV, right? I mean, when we're doing this video, same thing. We're live, or the TV is live. This obviously is taped and then goes out. But, you're on live national TV. Your view is not working out. You're actually going to have to, respond to your view being wrong in real time. You have to play fast and loose, right? You just have to go with it because if you try to fight it or if you try to deny reality, it's not a great strategy, usually in life, or certainly not for investors, right? Investors have to face reality. It's one of the things that I like about being in the markets is that it is reality. And so, I thought there was a real juxtaposition there between, hearing what I just heard a couple hours before. That call with Coach Patke was 7 p.m. on Tuesday night, and 11 p.m. Tuesday night, I was live on Bloomberg TV. And at 12:30, 1 o'clock, I was saying, we got it completely wrong on the election outcome. So great lessons to be learned.
Sure, there's a fair bit of coffee involved there as well, Jay. Let's. It comes back to a bit of an analogy here, right? Like, would you rather be right or make money, right? And what are your thoughts on that part of it?
Yeah, that's exactly right. And that's what really came to us Tuesday night, but more really Wednesday morning, when we saw, obviously, the election had been called around 5:30. Futures markets were ripping. We came into Bloomberg at 8 pre-market. And that was really what was resonating in our minds, right? Was the old adage, the old investment question, would you rather be right or make money? And it's so interesting because, my training, my background, the bulk of my formal experience was at Morgan Stanley as a sell side strategist. And there, you were supposed to be right? That was the objective because we weren't really managing money. We were guiding people, advising people, and that advice, we wanted it to be right. So for years, I wanted to be right. And then I switched, left Morgan Stanley now 20 odd years ago. And for the last decade or more, been, managing my own capital, providing strategic advice to clients, and now providing model delivery to our clients at TPW Advisory. So we want to make money. And so it was just a fascinating kind of real-time example of being wrong on the political outcome, completely wrong, and yet making money. Because Wednesday ended up, being one of the best days for our flagship model portfolio, our global multi-asset GMA model, actually outperformed its benchmark on Wednesday by over 140 basis points, which is a huge amount to beat the benchmark on a single day basis, almost 150 basis points of outperformance. So, we would rather make money at TPW Advisory for ourselves and our clients. And as a reminder, the bulk of my own, personal investable capital is invested in the global multi-asset model. And so, this is one of those occasions where, we were wrong on our outlook, but we were right in terms of making money. And obviously, that's really where we want to be.
Okay, so where we want to be is a very good point there to finish on, because how are you thinking about things tactically and strategically going ahead now?
Yeah, that's also a good question. And I think it is smart to separate it into both tactical and strategic, right? So tactically, we want to enjoy the bounce here, right? It's we want to participate, and we have participated as we just discussed, because there's not just the election; it's also, and the big reason for the pop on Wednesday was the collapse in volatility. So investors need to understand that there was a lot of fear in the volatility indices about a contested election. And with Trump winning, all that worry about contested, as we've seen, right? The Democrats, Harris conceded, promising a smooth transfer of power, which is exactly what should happen in an election. Did not happen, obviously, in 2020 with former President Trump at that point. But that fear evaporated. So the VIX had actually one of its best days in 20 years on Wednesday. Complete collapse in volatility. Now the VIX is under 15. Wednesday morning, it was over 25 or thereabouts. Same with the MOVE index, which is the Treasury market volatility index. It was running at 135 in the middle of the week. Today, it's at 105. So first off, you've had a collapse in volatility. Secondly, seasonality. We're in the best 3-month period of the year for stocks. November through January is the best 3 months of the year for equities. And then you have the technicals, which are obviously supportive. Markets are breaking out. Small caps are breaking out. Some of the thematics like fintech, like crypto, breaking out of huge bases. And so technicals are good. And most importantly, at the end of the day, fundamentals. Q3 earnings are about over. And JP Morgan is reporting that earnings, the beats were about 75% of the S&P 500 beat estimates. Estimates are coming in virtually double what they were at the beginning of the earnings season, roughly 8% versus 4%. And so fundamentally, those are all attractive things. Now, strategically, and the last thing is to mention is just the fact that we're probably setting up for what could be a really aggressive push into year end, right? Because weeks like this are what explains why the vast majority of active managers underperform. Because if you've had any cash, you're underperforming. And a lot of people had a lot of cash, which is why we saw the moves that we did on Wednesday and Thursday. But here we are 7 weeks before the end of the year, and people are underperforming. And you have all this idea of a potential hothouse effect where Trump stimulates an already strong economy growing well above potential. At the same time as China is responding, right, to the risk of Trump tariffs. And even where, as you mentioned, Germany, their coalition government has collapsed because, sitting stuck in neutral is not a solid, positive policy response when things are moving so quickly. So that drops us into the strategic bucket. And here, we want to see whether the Republicans win the House, because if they do win the House, that means tax implications, potential tax cuts are much more on the table. And it really is a battle a little bit about, tax cuts helping earnings versus tariff hikes hurting earnings. And JP Morgan, for example, came out saying that if a Trump administration were to implement 60% tariffs on all Chinese imports, which is what the campaign ran on, that would basically take away almost half of the expected earnings growth in 2025 versus 2024. So that's a big number. So the way we're thinking about it strategically, again, to kind of keep it simple so we can play fast and loose, is that you have an expensive, overowned asset, which is U.S. financial assets, as expressed through the dollar, which is now looking at deteriorating policy, right? One of the things we said in Bloomberg was Democrats had really good economics, but bad politics, right? U.S. economy is the envy of the world right now in the developed markets. On the other hand, Trump, poor economics, good politics, won the election. So the U.S. asset, expensive, overowned, potentially facing deteriorating policy versus things like China with cheap, underowned, where the policy mix is getting better as they realize they need to do more to support domestic consumption. And even potentially in Europe as well, which is where virtually everyone thinks Europe is the big loser. But yet the euro, after falling off a little bit Tuesday, Wednesday, Thursday, is essentially flat on the week. So how much is already in the price? And again, that Europe is a cheap, underowned asset. So it's a really interesting dynamic strategically as we think about the implications of policy discontinuity to the negative effect in the U.S., policy moving more positively in places like China. And then in Europe, in our tripolar world, right? Asia, Europe, and the Americas. In Europe, you have the German government likely recognizing that they have to be more aggressive on the policy front if they want to compete in the world that's reshaping as we speak. So, more to come on that front. Next week is our monthly. We do a much deeper dive We'll probably know about the outcome of the House by that point, hopefully, whether the Republicans take the House, and we'll be able to assess kind of this play a little bit more thoroughly. But for now, lots of lessons learned. It's better to make money than to be right. As a professional, you got to step up and admit when you've made a mistake. And you need to kind of think both tactically, particularly as we go into the end of the year, best time of the year for stocks, and strategically, how do you want to allocate? We're overweight equities. We're deeply underweight bonds. That's why we're outperformed so much on Wednesday. And we're overweight commodities. If we have the U.S. stimulating an already hot economy, we'll end on this note. U.S. stimulating an already hot economy, China stimulating its economy to reduce the risk to tariffs from an export-driven economy, and even Europe stepping up to the plate. Don't see how that's bad for commodities, right? And so that's an interesting area, and emerging markets continues to be an area of interest for us as well.
Well, Jay, listen, go have a nice, relaxing weekend. Kick your feet up, watch the game tomorrow afternoon. We're going to get North Carolina State, I think, for Duke, right?
Look at you. I've converted you into a Duke fan, man. You even know who we're playing. Bravo. Well done, buddy.
You might want to slow down. I'm a Buckeye fan.
Oh, okay. Well, okay, we'll see how it all plays out.
Jay, enjoy the weekend, rest up, and look forward to the monthly next week.
All right, Scott, you as well, buddy. Take care.
And for everyone else out there, good luck investing.